Welcome back to Smart Stock Sam, the channel where we cut through the noise and hand you the real mechanics behind every big market move. If you are new here, smash that subscribe button right now because today's video is exactly what this channel is built for. Here is a question for you. What if a stock could be up over 150% across 5 years and still be considered one of the most dangerous bets in today's market? Today, we are talking about HIMS and HERS Health, ticker HIMS, sitting at $26.88 as of May 7th. We are going to walk you through the brutal one-week collapse, the triple threat of headwinds hitting this company from 3 directions at once, the massive short squeeze coiling underneath the surface, and a jaw-dropping mystery trade buried deep in the options chain targeting an $80 price by December of next year. And right before the May 11th earnings call, we will hand you a precise tactical blueprint, where to enter, where to cut losses, and exactly what 3 numbers to stare at the moment that report hits the wire. Stay locked in from start to finish, because this setup only shows up a handful of times a year. But before we get to any of that, let us confront the cold, brutal reality of the past 7 days, because you cannot understand where this stock is going without fully grasping what just happened to it. On a 5-year chart, HIMS looks like a winner, a total return of 153.8%. This was the undisputed darling of the telehealth boom, a company that took the friction of seeing a doctor and turned it into an app, a subscription box, and a loyal recurring customer base. Investors rewarded that vision generously for years. But now, look at the right side of that same chart. In just 1 week, the stock cratered 11%, dropping from $31 all the way down to where it sits right now. That is not a bad week. That is a micro breakdown, a signal that the market's perception of HIMS and HERS is shifting at a truly fundamental level. The long-term believers and the short-term skeptics are standing on opposite sides of a very thin rope, and May 11th is the moment that rope gets pulled hard in one direction. Everything depends on which side wins that fight. So what caused this sudden, sharp collapse in investor confidence? Could it really just be one bad headline? This is what we call a triple threat, 3 separate forces converging at the exact same time. First, the regulatory hammer came down. The FDA is proposing new curbs on mass compounding for branded weight loss drugs like semaglutide and tirzepatide as drug shortages ease. This hits HIMS directly in its highest margin business. Second, the competition just turned vicious. Amazon One Medical launched their own GLP-1 drug bundle, and then Eli Lilly, the pharmaceutical giant itself, received FDA approval for an oral weight loss pill called Foundayo. Think about that. If a patient can order a pill directly from the manufacturer who invented the drug, does that patient still need a monthly subscription from HIMS? That question alone is worth several points off the price. Third, we have a governance picture getting increasingly ugly. A CEO to employee pay ratio of 272 to 1, board members voluntarily walking away from the table, and class action lawsuits tied to data security concerns that are still playing out in court. Regulation, competition, and internal dysfunction, all landing at exactly the same time on exactly the same stock. When you stack those 3 forces on top of each other, a sharp sell-off is not a surprise. It is a mathematical certainty, and the price action reflects that perfectly. And these headwinds are about to hit the actual bank account. Here is the margin trap every investor needs to understand. For the past year, HIMS has made excellent money on compounded preparations, high-margin, custom-mixed versions of popular branded drugs. That era is ending fast. The company is being forced to transition toward lower-margin branded partnerships, and the numbers show exactly how painful that shift is. Management has already telegraphed a $65 million revenue hit in the first quarter alone because of compounding restrictions. $65 million. For a company of this size, that is not a gap you paper over with a press release. The long-term pivot toward branded partnerships with companies like Novo Nordisk could eventually be a winning strategy. but the transition is going to bleed margin before it builds it back. When the fundamentals look this shaky, smart money goes to the chart looking for somewhere to stand. Technically, this stock is in a danger zone. At $26.88, it is sitting right on the Fibonacci pivot level of $26.81. More critically, the price has already sliced through the 50-day moving average at $27 and the 100-day at $28. In technical language, that is a confirmed bearish breakdown, both averages now acting as resistance overhead rather than support below. However, there is a line in the sand. The 200-day moving average at $24.29 is the critical long-term support. If HIMS breaks below $24, there is no technical safety net beneath it. But as long as it holds above that level, the long-term uptrend remains technically intact. That is the one thread the bulls are clinging to. Price location is only half the story. Momentum tells you the speed and direction of the move. The indicators are flashing caution right now. The 14-day RSI is at 51.75, which sounds neutral, and that is actually the problem. The stock is not yet in oversold territory, meaning there is still room to fall further before it reaches the kind of value floor that triggers serious bargain hunting. Even more concerning is the MACD, which just generated a definitive sell signal as it crossed below the signal line on the daily time frame. When a stock breaks key moving averages and simultaneously throws a MACD sell signal, the technical message is unambiguous. The path of least resistance over the next several days is likely downward. Now here is where this story gets very interesting for contrarian traders. What if the bears are walking right into a trap? Look at the short interest. 33 to 36% of the entire float sold short. More than 1 in 3 freely tradable shares in this company has someone actively betting against it, and it would take over 5 full trading days for all of those shorts to buy back and cover their positions. In market terms, that is what we call a coiled spring, a setup where a single piece of good news can force a mass buying event, not because those short sellers want to buy, but because they have absolutely no choice. If HIMS walks into May 11th earnings and even slightly beats expectations, those 33 to 36% of shorts become forced buyers all at once, and forced buyers arriving simultaneously create the kind of violent, fast-moving short squeeze that sends a price rocketing regardless of what the underlying technicals are saying. The bears are confident right now, but they are also dangerously exposed if anything goes right for this company on Sunday night. And if you think the short interest is wild, wait until you see what is happening in the options market. Even while the stock is falling, 72% of all options activity recorded on May 1st was call options. Retail traders are overwhelmingly betting on a bounce. But then comes the anomaly that stopped serious options traders cold. Someone placed a massive, unusual trade of 2,800 contracts for the $80 strike price, expiring in December of 2026. $80, nearly triple where the stock trades today. On top of that, implied volatility is running at 100%. When the options market prices in volatility that high, it is not making a directional call. It is simply saying a massive move is coming and you had better be ready. Whether that mysterious $80 bet is a hedge, a speculative moonshot, or someone sitting on information the rest of us do not yet have, that is the question the market cannot answer before May 11th. While retail is placing moonshot bets, the institutional money is having a quieter, more divided conversation. Behind the scenes, a capital tug-of-war is underway. Last quarter, 311 institutions decreased or completely exited their positions, while only 225 added. Forerunner Ventures divested entirely. Farallon Capital cut their position by 68%, but on the other side, Vanguard, the largest index fund manager on the planet, actually increased their position by 72%. When the world's biggest passive investor buys while hedge funds run, the message is clear. Even the institutions are divided. That vacuum of consensus is exactly what makes this setup so explosive heading into earnings. But if you want to understand what might really be coming, stop looking at institutions and start looking at insiders. Over the last 6 months, the ratio of insider buying to selling is 0 to 22. Not one C-suite executive has purchased a single share with their own personal money. The CFO, COO, and Chief Legal Officer have all logged significant divestments during the same period. Executives sell for many legitimate reasons: taxes, diversification, personal needs. But 22 sales and 0 purchases, leading directly into one of the most consequential quarters in this company's history, is a data point you simply cannot wave away. So if insiders are quietly heading out, what does the official Wall Street view look like? The analyst community is split right down the middle. 19 hold ratings, which in analyst language translates almost directly to "we have no idea." On the bull side, JPMorgan initiated with an overweight rating and a $35 target, citing the long-term branded partnership pivot and international expansion. On the bear side, Citigroup and Deutsche Bank cut targets to $24 and $25 respectively, arguing near-term margin compression will be severe. It is a battle between long-term vision and short-term math, and May 11th is the ultimate tiebreaker. Before we get to the trade, let us acknowledge the fundamental anchors holding this company together. Despite the chaos at the surface, the underlying business is sticky. HIMS has averaged 29.5% annual customer growth over 5 years, with a 16.9% free cash flow margin, and they spent $1.15 billion to acquire Eucalyptus, a telehealth platform with strong footholds in Australia and Japan. That acquisition is their insurance policy against U.S. regulatory pressure. If the FDA closes one door in America, HIMS has already opened windows in 2 of the fastest-growing healthcare markets in the world. The business is not broken. It is transitioning, and transitions are exactly when fortunes are made or destroyed, depending on which side of the trade you are sitting on. Now here is your actionable blueprint for May 11th. For a tactical entry, you want the $25.50 to $26 zone, close to that major support floor without leaning on it. Your stop loss must be firm and non-negotiable at $24 even. If the stock breaks through the 200-day moving average, the trade is dead. On the upside, your conservative recovery target is $29.46. But if that coiled spring triggers a genuine short squeeze off earnings, the aggressive target climbs all the way to $35, matching the JPMorgan price objective. The risk to reward on that squeeze scenario is extraordinary, but it requires discipline that most retail traders do not actually have when a stock starts moving violently against them. When that report drops, ignore the headline earnings per share number for a moment and watch these 3 things specifically. First, the $65 million gap. Did management find a way to recover the revenue lost from compounding restrictions? Second, Eucalyptus return on investment. Is that $1.15 billion acquisition contributing real revenue yet, or is it still pure cost? Third, customer acquisition cost. With Amazon and Eli Lilly spending marketing budgets that dwarf what HIMS can deploy, is winning a new subscriber getting dramatically more expensive? If customer acquisition cost is rising and the revenue gap is not closing, the stock likely heads lower. If they beat on even 2 of those 3 metrics and guidance is not a disaster, the squeeze is on, and the move could be violent. Before we close, something important needs to be stated clearly. Nothing in this video is financial advice. I am not a licensed financial advisor or investment professional. Everything covered today is strictly for educational and informational purposes. Investing in stocks carries significant risk, including the potential loss of your entire principal. Always conduct your own research. Consult a qualified financial professional before making any investment decision, and never invest money you cannot afford to lose completely. The market owes no one a return. Here is the bottom line on HIMS and HERS. The risk is absolutely real. Margin compression is painful. The competition has never been fiercer, and the insiders are not exactly buying with both hands. But for a disciplined tactical trader who understands asymmetric risk, the convergence of extreme short interest and a solid $25 support floor creates one of the most genuinely interesting setups in the market right now. You are betting on whether a coiled spring beats a regulatory wall. One way or another, May 11th lights the fuse. Now I want to hear from you. Drop your answer in the comments right now. Do you think HIMS can actually beat the earnings and achieve previous highs, or the headwinds are too strong to allow any significant upside? I read every single comment and replied to as many as I can. If this breakdown gave you a real edge today, hit that like button. It tells the algorithm this kind of deep analysis deserves a wider audience. If you are not yet subscribed to Smart Stock Sam, now is the moment, because we deliver this kind of full stack breakdown every single day on the tickers that actually matter. And if you want to directly support independent research like this, you can send a super thanks right here on YouTube using the support feature below the video. Every single contribution funds the data tools and research hours that make content like this possible. Stay disciplined, stay patient, and I will see you in the next one.